Guangdong's foreign trade surges to $633.9 billion in 2023, diversification pays off. In an astonishing turn of events, Guangdong's foreign trade has soared to unprecedented heights, clocking in at a staggering $633.9 billion in just the first 2 quarters of the year. This represents a solid 4% increase compared to the same period last year, as reported by the Guangdong customs authorities in a recent press conference held in Guangzhou. But here's where it gets interesting. Guangdong's circle of friends has expanded significantly, leading to a more diversified global market strategy. According to Zhang Ke, the deputy director of the Guangdong sub-administration under China's General Administration of Customs, the province's trade partnerships have broadened, with the Association of Southeast Asian Nations, ASEAN, taking the lead as the largest trade partner. The trade volume with ASEAN nations surged by 5.9% to reach 757.13 billion yuan, accounting for 16.6% of Guangdong's total trade, a slight increase from the previous year. However, the story doesn't end there. Guangdong's trade with other significant partners, such as the European Union, Japan, and South Korea, also showed positive growth. Surprisingly, the United States was the outlier, experiencing an 8.1% drop in trade with Guangdong. And this is the part most people miss. Guangdong's trade with countries participating in the Belt and Road Initiative, BRI, grew by 3.8%, reaching 1.79 trillion yuan. Particularly noteworthy is the 23.1% year-on-year increase in trade with the 5 Central Asian nations. Breaking down the numbers further, Guangdong exported goods worth 2.89 trillion yuan and imported 1.66 trillion yuan, marking respective year-on-year growths of 1.1% and 9.5%. What does this mean? The growth rate surpassed the national average by 1.1 percentage points, and the total foreign trade, imports, and exports all set new records in the first half of the year. This remarkable performance raises questions about the sustainability of such growth and the potential impact on global trade dynamics. China's FDI decline, strategic opportunities amid economic shifts. China's foreign direct investment, FDI, inflows have faced a prolonged decline since 2023, with 2024 marking the steepest drop on record, a 27.1% year-on-year contraction. By early 2025, FDI continued to slide, falling 10.9% year-on-year to 320.8 billion renminbi in the first 4 months of the year. While these figures may signal short-term challenges, they also reveal a pivotal moment for long-term investors. The decline is not a collapse but a recalibration, driven by structural shifts in policy, sectoral resilience, and global capital's evolving risk calculus. For those willing to look beyond the headlines, China's FDI slump offers a unique opportunity to engage with a market undergoing strategic transformation. Policy reforms, a path to structural resilience. The Chinese government has responded to the FDI decline with a suite of targeted reforms aimed at stabilizing foreign confidence. Key initiatives include expanded market access in high-value sectors such as cloud computing, biotechnology, and healthcare, alongside revisions to the catalog of encouraged industries for foreign investment. These changes clarify regulatory expectations, reducing ambiguity for foreign firms. For instance, the extension of tax holidays for foreign investors until 2027 and the introduction of incentives for R&D centers signal a commitment to fostering innovation-driven growth. Moreover, the government is exploring policies to encourage reinvestment of profits earned in China, a critical step toward enhancing the stickiness of foreign capital. Such measures are designed to align with China's broader economic strategy, transitioning from export-led growth to a model anchored in domestic consumption and technological self-reliance. While regulatory unpredictability remains a concern, the recent focus on transparency and sector-specific guidance suggests a gradual shift toward a more investor-friendly environment. Sector-specific resilience, high-tech and services as growth engines. Despite the overall FDI decline, certain sectors have demonstrated remarkable resilience. High-tech industries, including e-commerce, aerospace, and chemical pharmaceuticals, have attracted significant inflows. In the first half of 2025, these sectors saw growth rates exceeding 50% year-on-year, driven by China's push for technological sovereignty and global competitiveness. The services sector, particularly finance and logistics, has also emerged as a dominant draw, accounting for over 72% of total FDI in early 2025. This sectoral realignment reflects a strategic pivot by both Chinese policymakers and foreign investors. For example, while manufacturing FDI has slowed, investments in EV supply chains and advanced manufacturing remain robust. Companies like CATL and BYD are expanding their global footprints, leveraging China's domestic capabilities to scale production and reduce costs. Similarly, European firms are increasingly focusing on joint ventures in green technology and digital infrastructure, where China's market size and regulatory support create compelling synergies. Global uncertainties and geopolitical dynamics. The FDI decline cannot be separated from broader global uncertainties. U.S.-China tensions, U.S. tariff threats, and European regulatory scrutiny have heightened risk perceptions. However, these challenges also underscore the importance of diversification and long-term positioning. For instance, while European firms have scaled back capital commitments, their interest in China's high-tech and services sectors remains strong. In 2025, Japan and the UK saw FDI inflows surge by 70.2% and 60.9%, respectively, reflecting a strategic reallocation of capital toward China's innovation-driven economy. Strategic investment opportunities. For long-term investors, China's FDI landscape presents three key opportunities. 1. High-tech manufacturing. Sectors such as EVs, semiconductors, and industrial automation are benefiting from both domestic demand and government subsidies. Companies with expertise in these areas can leverage China's scale and supply chain efficiency. 2. Services and digital platforms. The services sector's dominance in FDI inflows highlights the potential for investments in fintech, logistics, and e-commerce. These industries are supported by China's digital transformation and a growing middle class. 3. Policy-driven sectors. Areas like biotechnology, green energy, and healthcare are being prioritized through tax incentives and regulatory reforms. Investors with a long-term horizon can capitalize on these policy tailwinds. However, success requires a nuanced approach. Investors must navigate regulatory complexities, geopolitical risks, and sector-specific challenges. For example, while the EV sector is booming, competition is intensifying, and regulatory hurdles for foreign automakers remain. Similarly, the tech sector's recent rebound is contingent on resolving issues related to data governance and intellectual property. Conclusion: navigating the transition. China's FDI decline is a symptom of a broader economic transition, not a terminal decline. The government's reforms, sectoral resilience, and strategic realignment of global capital all point to a market in transformation. For investors, the key lies in identifying sectors and partnerships that align with China's long-term goals, particularly those that benefit from its innovation-driven growth model. While the path ahead is not without risks, the current environment offers a rare opportunity to engage with China at a pivotal moment. By focusing on high-value industries, leveraging policy incentives, and adopting a patient, strategic approach, investors can position themselves to benefit from the next phase of China's economic evolution. Guangdong's foreign trade reaches record high in H1 2025. Guangdong just shattered its own trade records, and the numbers are staggering. In the first half of 2025, the province's total imports and exports skyrocketed to a historic 4.55 trillion yuan, marking a 4% year-on-year surge that outpaced the national growth rate by a full 1.1 percentage points. But here's where it gets interesting: this isn't just a blip. Despite a global trade landscape rocked by uncertainty, Guangdong has defied odds with 8 consecutive quarters of positive growth since Q3 2023. So, what's driving this momentum? For starters, Guangdong now accounts for a whopping 20.9% of China's total foreign trade, up 0.2 percentage points from last year, contributing a massive 28% to the country's trade growth. Exports alone hit 2.89 trillion yuan, up 1.1%, while imports jumped 9.5% to 1.66 trillion yuan, both all-time highs for the period. But wait, trade diversification is the real story here. ASEAN, Guangdong's largest trading partner, saw trade grow 5.9% to 757.13 billion yuan, grabbing 16.6% of the province's total trade. Other major partners like Hong Kong SAR, 7.9%, the EU, 7.2%, and Taiwan Province of China, a whopping 26.2%, also thrived, though trade with the US slid 8.1% amid tensions. Meanwhile, Belt and Road countries contributed 1.79 trillion yuan, up 3.8%, with Central Asia posting a 23.1% surge. On the ground, a record 130,000 enterprises, up 7.6%, drove activity, led by 110,000 private firms, 8.6% growth, that dominated 64.2% of total trade. But here's the controversial part: while private players are booming, critics argue their reliance on export-driven growth leaves them vulnerable to global shocks. Your take? Industrially, Guangdong is upgrading fast. Mechanical and electrical exports soared 7.2% to 1.96 trillion yuan, 67.8% of total exports, with computers, 15.9%, electrical equipment, 17.2%, and integrated circuits, 27.1%, leading the charge. Emerging tech like drones and electric vehicles posted 29.2% and 28.8% growth, respectively, while cell phone brand exports hit 655.27 billion yuan, up 11.2%. And this is the part most people miss: Guangdong's success isn't just about numbers, it's a blueprint for China's economic rebalancing. But can this growth last amid geopolitical pressures? Share your thoughts below.